We got past the Thanksgiving holiday in fair enough shape, and we're now heading toward the Christmas holiday that is fast approaching. Although the S&P 500 continues to rack up new record levels in 2019, much of Main Street and Wall Street are now turning their attention to 2020. So, what will the new year bring for the stock market? Let's take a look at our crystal ball. While there is a vast range of views regarding the performance of U.S. equities for 2020, the top strategists on Wall Street appear to unanimously agree that next year's performance will come nowhere near that of 2019. With the Nasdaq up about 28%, the Dow up about 17%, and the S&P 500 up about 23%, only one of those surveyed by MarketWatch predicts the S&P 500 to rise 10% next year. Most of those surveyed predicted year-over-year advances from about 4.4% to about 9.2%. Further, four analysts expect the S&P 500 to decline in 2020. Credit Suisse's Jonathan Golub has the highest expectations, predicting the S&P 500 index will rise to 3,425 by the end of 2020. That's a 10% increase from the recent S&P 500 close. Golub has stated in recent note that 2020 will bring a sharp rebound in economic performance similar to what was experienced in 2016 going into 2019. He also predicted continued strength in corporate buybacks that will help the forward price to earnings multiple on the S&P 500 rise from 18.1 to 18.9 by year end. This expansion, along with 5.6% earnings per share growth, forms the basis of Golub's target. David Costin, the chief U.S. equity strategist for Goldman Sachs, has the next most optimistic target. He has stated in Goldman's 2020 outlook that S&P 500 companies will benefit from above-average growth in 2020 and rising profit margins that will boost earnings per share by 5%, while low interest rates and relatively poor returns in other asset classes like bonds will push the market multiple to 18.6. As usual, Morgan Stanley appears to be one of the most bearish. According to Michael Wilson of Morgan Stanley, he expects the S&P 500 to fall to about 3,000 by the end of the year. That would be a decline of about 3.7% in 2020. According to Wilson, easier monetary policy and trade stabilization will help global growth accelerate, but only stabilize GDP growth in the U.S. at about 1.8%, leaving pressure on corporate margins from tight labor markets. He further argued that central bank stimulus may keep stock prices elevated in the near term, but by April, the liquidity tailwind will fade and the market will focus more on fundamentals, where uncertainty is high. Francois Trahan of UBS also has a target of 3,000 on the S&P 500. He believes there will be an earnings recession for the S&P 500. Directly in front of us, we see S&P 500 forward earnings falling and expect them to remain under pressure for several quarters. So, what did the charts show? Let's take a look. And so for our look at the market, we're going to look at the SPDR's S&P 500, the SPY, which closed on Friday at 314.87, near a record high. Going back to 2009, we've had a very nice uptrend all the way. A few pullbacks here and there. I'm looking for another pullback, but is it going to come soon? I can't really say. All I can say is that we are elevated, so the probabilities are that sooner or later we'll have a little bit of a pullback. I'm not looking for a crash, just for a little bit of consolidation. Now moving here into the MACD, what I have been saying for months and months and months is that this formation here is very similar to the formation from 2015 to 2016. What I'm going to tell you now is that the move with the fast line through that slow line and acceleration is going to be similar to the time frame of about 2017, where the fast line moved up through and accelerated here for about a year. Are we going to continue for about a year? I'm not quite sure, but that acceleration is very hard and very fast. We're at an elevation of 14.09 for the fast line and 12.49 for the slow line. That is a very strong level. I think we continue. Now, if you go all the way back to, say, 2002 and draw this line here, I think we continue on that. This was an aberration, in my opinion, in 2009. So go and look at this line here. I think we continue on up, at least for the midterm and maybe the long term. It's not going to be a straight line. We're going to have a pullback or a correction. So, I think we are going to continue to head up in the long term, at least for now. And that's also shown here in the histogram with that strong move on up. Very, very strong. Price rate of change looks good with that bottoming and basing here. Fast lines come through the slow line. We're trending along sideways, but I think we'll pop up, head to that 50 line soon enough. Similar to what we saw back there in 2015, 2016, and now I think we're going to do something similar to 2017. Same thing here in the relative strength index. We're at 69.99. I think we'd based, bottomed, and we're heading on up. That's what we did here, on up there as well. Same thing here for the stochastics. We're in the overbought territory, and I think we can stay there. From that base there, we moved on up and stayed in that overbought territory for over a year. Can we do that here? We'll have to wait and see, but things look good for now. Moving into volume, volume looks fine. And then the Williams pretty much echoes the same thing that we saw in the stochastics. Everything looks very healthy. Moving on up here to the price chart. Once again, I'm not going to give a dollar or a point figure on a forecast, but just given that survey, in my humble opinion, will probably be toward the upper end of that range. Again, this is my humble opinion, but that's what it looks like from my viewpoint here today. We'll certainly know more in 2020, and I'll be there. Hopefully you will too. So for today, that's ChewDog Charts. Thank you.